Okay, let's see if this works. 3, 2, 1. Going live. And hello, everybody. Welcome once again to the Convex Community Call. Today we've got an exciting topic to talk about, which is tokenomics design. So be talking a little bit about the tokenomics design for Convex, but also I think more broadly about some of the ideas and theories and what people have seen in the world of tokenomics, what's interesting, what are the sort of hot topics, and maybe delve into some of the sort of the big ideas of what we might be building for the future. So I've got with me here on the community call is Rich. Hi, Rich. You hearing me okay?
Yeah, I hear you.
Awesome.
Just I couldn't turn the mic on. That pop-up on the bottom of my computer wouldn't let me turn the mic on.
The joys of internet comms, eh? So thank you for suggesting the topic.
I'm pretty excited about this topic.
Yeah, no, it's a super topic, and I think one of the reasons it's so cool is that it's still a brave new world. Yeah, I mean we're still living in a world where everyone thinks about money and finance and banking and what value means in fairly traditional ways, because people have just got used to it over the past 100 years. And I think what tokenomics potentially does is it changes the way that people think about economics more broadly, and how we think about value, and how we think about the exchange of value, and how we think about how we want to create economic systems that help people exchange value. And I think tokenomics is a very important sort of piece of that puzzle. And economics was my degree. I love economics. It's a fantastic topic. It is also full of so much nonsense. Yeah, most economic theories are basically nonsense. They're just sort of hand wavy approximations based on some fairly flimsy mathematical model that inevitably fail when it comes into the contract with the real world. So I think there's also though these amazing gems of truth in economics and amazing ideas that we can learn from, and particularly around sort of the economic theory side. And I hope we can bring all of that into what we're doing at Convex in terms of building the right kind of economic incentives and the right kind of structures that are going to sort of help people build these open economic systems of the future. So, Rich,
one of the things I appreciate, Mike, is that you've put a lot of thought into the convex tokenomics early on. For as long as I've been at working on this project with you, the tokenomics have been pretty fairly put together. What interests me is, as I want to build on top of convex, what would be the right tokenomic model for what we're doing. And so that caused me to do a lot of research on all of the things that have gone wrong with tokenomics in the past as well.
Yeah. And so we've got a lot to unpack here. Yeah, we've got there's the tokenomics that we have for Convex itself, which is I think interesting. I mean it's certainly from a lot of the people in the crypto space I talk to, they say it's relatively unusual or novel, which I think is a good thing, and I'll say a little bit about why I think that's a good thing. But then there's also the tokenomics of anything that you build on top of Convex. So as you say, you're looking to launch a product on Convex. You need to design the tokenomics for that project and for any sort of assets that's going to use, and that's another ball game. And then there's tokenomics more broadly. Yeah, how do tokenomics interact with broader ecosystems? How do tokenomics of different decentralized platforms interact with each other? How this sort of affects the sort of market as a whole. So a lot of these things sort of become interlinked. Maybe if I start talking a little bit about some of the principles that I think are important in tokenomics, and I think this often gets a bit overlooked. I think a lot of people doing tokenomic design sort of just they do what everyone else has done, yeah, and that goes in waves, that goes in trends. You've got like what happens with the ICO boom, for example. And the model's fairly standard. You pre-mine a whole bunch of tokens. you hand out large chunks of those to advisors, investors, early employees, core team, who between them often end up having quite a high share of the token supply, and then you create some mechanism by which the other tokens get distributed, whether that's through an exchange listing or a public sale or an ICO or some kinds of rewards going out to miners or people who are providing some sort of services or infrastructure in the ecosystem. And the typical tokenomics is is some combination of those things, and that's not necessarily bad, but I think it opens up quite a few risks. And I think one of the observations that principles that I'd like to talk about, and I think is really important, is sustainability. And this was, I guess, an observation from, well, what happens to the token supply once you've pretty much issued it all. Yeah, once you've issued 95% of the supply of some coin, and that includes things like Bitcoin. Most of the supply is out there in the market. It's being traded, etc., etc. And there's not much new supply being created. Maybe there's not much being destroyed, but some is getting lost. You basically got this sort of fixed supply, effectively, of tokens. And the problem with that is, I think it's not very sustainable. And let me explain why I believe that. If you are to buy some tokens in that kind of environment, the money that you spend to buy the tokens, let's say you've got some thing you want to use them for, is going to someone who's selling the tokens. Yeah. So the money is just that the tokens are changing hands. So money is changing hands, but it's not actually helping the ecosystem at all necessarily. Yeah. You might the price might go up and down, but the person who sold is going to lose. The person who bought at the right time is going to win, and vice versa. Yeah, it kind of becomes a bit of a zero-sum game, and this then runs into the big problem that what happens if a crash happens? What happens if there's a dump? Well, suddenly everyone wants to dump, and suddenly the price then crashes 50, 80, 90, 99%, because the entire thing is based on speculation about where the price is going to move next. And I think this is a symptom of having a very fixed supply. It doesn't have to be absolutely fixed, but it has to be like pretty much reaching the limit of the supply. You get this tendency towards volatility, and you get this tendency for it becoming a bit more of a zero-sum game. Yeah, no one's creating any value if I always like thinking about paintings or art as an analogy. Yeah, if you've got this Picasso painting, and you buy the Picasso painting at 1 million, and then you sell it at 100 million, you've profited. You've made 99 million. Yeah, but no value was created. Yeah, you've still got the same number of Picasso paintings in the world. You've personally profited from it. Who lost? Well, the person who lost is the person who paid 100 million rather than buying it earlier when you did for 1 million. Yeah. So all you've done is gained a wealth transfer from the future buyer to the early buyer, and of course vice versa if prices are going down. Yeah, the early buyer is transferring cash to the future buyer. So you're not creating any value if all you've got is the same thing changing hands. And I think to have a really good sustainable ecosystem, you need it to be linked to a value creation engine. How are you creating utility for users? How are you creating revenue, business value if there's some kind of if it's some kind of more like enterprise focused, or how are you creating social value, ecosystem value if it's more of a public service network like Convex. And I think the tokenomics needs to be designed to reflect that. How do you actually build something that's going to operate in a sort of sustainable basis? And that means that when people join the ecosystem, buying coins, buying into the ecosystem, you want at least a decent proportion of that money, new money coming in, to go back into the ecosystem. Yeah, not just to the lucky person who bought early, but to be to the benefit of the ecosystem as a whole. Whether that's more products, whether that's more capabilities, maybe that's improving the protocol. There's a lot of things you can do with the resources that can come in. So the convex tokenomics model was designed to say, okay, there's got to be a fair split as new money comes into the ecosystem. There's got to be a split between, yes, some of that is going to be a gain for people who bought early, who sell their who want to sell coins at that time, but also some of that money is going back into funding the growth and the development of the ecosystem. So you've got to find a balance between those things. Now, of course, you do need to have the right incentives. So you do need to reward the people who took a risk and were early purchasers of tokens. So there does need to be an expected return, but you can't have a situation where the entire return is coming from speculation or coming from persuading naive buyers, your pump and dumps and things like that, naive buyers to come in at an overinflated price. So that's where sustainability and fairness sort of live together.
That Picasso example reminds me of the Beeple sale of NFT for 69 million.
Exactly this kind of stuff. Yeah. I mean, it's happened a lot in the NFT space, I think. Yeah, that you get these,
right.
You get these items that have essentially super cheap to produce. Yeah, trading at very high prices, and you go, well, okay, well, what's happening here? Well, there's a bunch of wealth transfers going on, but creating NFTs is effectively, close to zero cost. Sure, there's some art and there's some, and all of that, but you've got mostly you've got money changing hands for fairly
speculators
trend
mainly,
oriented, or speculative reasons, or possibly transfer of funds reasons that people might be trying to evade scrutiny on. So it can certainly happen that the point is, if you've got a thing that has zero value, yeah, but your people are willing to pay $10,000, $1 million, $10 million for it, in the expectation that someone else will pay more, or because they want to transfer money somehow via the transfer of this token, then you're acting as a money funneling mechanism from from some people to others, without actually creating anything new in the world. Yeah, there's the token itself is, let's say you can print 1,000 of these things, and they're just like pixel art that some AI produced for in 10 minutes. So this kind of thing can happen, and so the valuation can become very inflated if people are using it more as either speculative or as a money laundering kind of tactic, and that's obviously unrelated to the the real utility value or the real artistic value of the thing being traded.
Right.
So I'm reminded of some great economists. There was Alfred Marshall and William Stanley Jevons. And this is old school now. We're going back, at least 100 years, I think. And these guys sort of pioneered what was called the marginal revolution in economics. And this was where economics theory started to come together, and the ideas of supply and demand and the mathematics behind supply and demand, how supply and demand works, sort of all converged around this time, and suddenly you started having consistent theories of economics. And now I still think that that was sort of the neoclassical economics. I still think that is some of the most useful economic theories, because it doesn't go crazy on, you know, on predictions, but it goes really about the principles, about, you know, how would you expect things to be priced. And one of the important things there is, well, look, price in equilibrium is equal to will be equal to two things. It'll be equal to the marginal utility of the least desirable item. Yeah. So if you're selling a million widgets, yeah, and your price will be equal to how much the millionth person values the widget. Yeah, and price will also be equal to the cost, the marginal cost of producing that millionth widget. Obviously, once you've taken into account all of the costs of capital and, you know, all of this kind of thing. So you've got this idea of an equilibrium where price is determined by, well, okay, what was the cost of producing this thing, and what was the utility? What was the utility value that someone got out of it, and particularly the last person to buy it? What value they got out of it, and that's equilibrium. Yeah, and if you have a good, well-functioning market that responds to price signals and that people are relatively rational, that's where you expect markets to ultimately end up. Now, they might take a very roundabout course to get there, and they might be knocked off by shocks. Yeah, if there's a price shock, then your price is going to go up because your costs went up, etc., etc. But, you know, at least in theory, that's the sort of attractor point for price in any economic market. You know, what's the sort of equilibrium between supply and demand, and most importantly, the marginal utility and the marginal cost of the last unit produced. And why am I saying this? Because I think this is really important for tokenomics. Yeah, if you have got something that's infinitely mintable, you just mint vast amounts of it, then ultimately you're heading towards, in equilibrium, some kind of zero price. Yeah, the stuff is effectively worthless. You could just hyperinflate it out of existence. So when you put in something like supply caps in tokenomics, or some kind of other constraint on supply, then that's what's constraining the supply curve, and therefore determining where your equilibrium is likely to end up. So you've got to think about where's that equilibrium going to end up on your tokenomics, and, you know, what utility are people going to be getting in that equilibrium? How valuable is the asset or the utility token, or whatever item it is? And I think that's a very useful way of thinking about it. I've got, you know, notebooks filled of little charts of demand and supply curves of, you know, how they behave, and what kind of implications that would have for tokenomics. But yeah, as I say, if you've got a sort of fixed supply, you end up with this sort of, you know, this sort of hard, steep supply curve that sort of, almost like a wall that you run into, and then any trades are just transfers between existing participants, and you know, there's not much sustainability in those kind of models. So that's why, you know, so Convex, we have a release curve model. We have a model where the supply of coins increases as the economic scale of the ecosystem increases. So broadly, it increases as sort of the overall market cap of coins increases, the supply increases, and the price increases. So that creates more like a smooth curve rather than this sort of hard supply cap. And that has a whole bunch of different advantages. But, you know, one of the big advantages is that it sort of helps you to avoid the sort of, you know, speculative bubble kind of situations. It's, you know, it's trying to really focus on real utility value and trying to make sure that we get the right kind of sort of equilibrium developing.
A couple of questions there on YouTube.
Oh yeah, awesome. So what we have, um, Bitcoin has a fixed supply of 21 million and is classed as a commodity, and the price is variable. Uh, Convex has 1 billion. Why is the price not so variable? Should Convex be a commodity, not a security? So I don't think my lawyers let me comment on whether anything is a commodity, a security, or these kind of things. So I may not be able to answer that question in its entirety. So I apologise for that. Um, so I think the supply, the actual number doesn't matter. Yeah, you could have one Bitcoin in the world, and and the satoshis will be worth a lot more. But I mean, the it's the percent of the supply or the scale of the supply, and the proportions of the supply that I think are more important than the actual absolute number. Now, you probably want to pick a number that results in meaningful human scales. Yeah, you don't really want people talking about 10 trillion in your currency, because human mind makes mistakes with zeros. So it's nice if you can have like meaningfully chosen natural numbers for values of coins or tokens. And I think that's probably the main reason. I think there's probably two reasons for choosing a scale or a max supply. One is, well, what's a meaningful sort of human number? Yeah. So if I want my coin to be worth about $10, then I might choose a number of coins that is consistent with a $10 kind of price. Whereas if I divide them into a million times that, I end up with a thousandth of a cent for each coin. So and then that's a kind of a bit of a tricky number to work with. So you want to choose your number of coins based on, does it give you sensible human units? Yeah, but other than that, it's just a scale factor. You just multiply all the numbers by the x, and it doesn't change the actual tokenomics ultimately. Um, uh, so um, the more interesting question I think is like, uh, what creates the variability? Well, so the thing is, if there was a lot of utility in Bitcoin, and I'm going to argue there isn't that much direct utility in Bitcoin. Yeah, you might make money at it. That's not the same thing. There's not. It's not like you can use Bitcoin to give you satisfaction. You can't eat it. You can't. Live inside it. You can't do all the things that you want to do in life because you've got Bitcoin. You can sell the Bitcoin and maybe you get a good price, and maybe that gives you some cash, and then you can go and do the other things. But the entire value is pretty much driven by expectations of what other people are willing to pay for it. Yeah, and if you time that well, you do well. If you time that badly, you do badly, as we see, and that leads to a lot of volatility. Yeah, that's why we have these bull runs and we have these busts, because once the price is going up, everyone gets the expectation it's going to go up more, so more people buy. Then the price goes up even more, etc., etc., and you get an asset bubble. Yeah, and we've known about these things since the time of Dutch tulip mania. Yeah, if you get an asset bubble and people pile in because they don't want to miss out, you get the fear of missing out, then the price just go way up. Yeah, traders love volatility. Yeah, because if you're smart, and if you're manipulating the market, and you're carefully tracking all the hype, and you know the right people, and you know who's going to say what when, then you can make a ton of money out of volatility. So yeah, traders certainly can make more profit in highly volatile markets. Um, they otherwise they have to use leverage. Yeah, but if you've got a lot of volatility, you don't need much leverage in order to make big trades. Um, but that volatility is obviously bad for people who want to use it for real world use cases, savings, or because they want to do something with the. As I say, I don't think Bitcoin has much utility in itself, but that volatility is generally bad for people in the real economy. And by real economy, I mean people who are producing goods and services of value that other people are willing to pay resources to acquire. So that's the real economy, as opposed to like the financial markets and the sort of
speculative stuff.
Yeah, speculative stuff. Now the thing is, speculation is not wrong, yeah, and speculators play a very important role when they are providing price discovery, yeah. So speculators provide information to the market. If lots of people are buying, then hang on, this is a signal that maybe people should be looking at this, and maybe in fact it's undervalued, and maybe it warrants further research. And of course, always do your own research. But prices prices move because of speculation, and that's not necessarily a bad thing. Yeah. However, speculation does not, other than price discovery and providing a bit of extra information to the market, speculation is mostly transfers from winners to losers. Yeah, and I think that's how I'd categorize speculation. There's a little bit of price, of value in terms of information being given to the market, but most of the value transfers in speculation are not because of actual utility. They're because there's a winner and a loser, and the smart money generally takes money off the dumb money, and that's basically the model that traders understand quite well, and they're all quite happily taking advantage of that. So so having a very fixed supply makes your system much more volatile, because there's always a winner and a loser. Any trade is going to be a plus and a minus, and it becomes, because there's tight constraint on the supply. It's sort of not moving. Then a small change in demand can trigger a sort of asset bubble. Yeah, as it sort of gets bid up at the margins. So
you mentioned that the supply cap it was equal. Having a supply cap, and then that Convex has a release curve model.
Yeah.
What's the governor on the release curve model?
I mean, that's a great question. So Convex has hard coded in the protocol a fixed maximum number of coins that can exist, which is 10 to the power of 18, so a billion, which is a billion Convex coins, and they're subdivided into a billion subunits. So you've got these little micro coins if you want to really play around with small change. Now that is a protocol defined cap. That is defined in the software, yeah, and and also in various documents and stuff. But I mean, it's a limit. It's something set in the code. The code enforces that there will always be an exact maximum of a billion coins in the global state of the network. And if you take coins from somewhere, there has to be an equal and opposite credit somewhere else, and therefore the total always stays the same. And that even includes if you waste them. Yeah, if you send a bunch of coins to an unreachable address, you've lost your coins, but they still exist. They're just sitting there in an address that an account that no one can access, and you've effectively burned them at that point. So that is a protocol defined cap. But what's important for tokenomics is not so much what the maximum cap in the protocol says. It's how is the actively circulating amount of coins going to behave? Yeah, what's going to happen with the amount of coins currently in circulation? So in Bitcoin, of course, there's sort of a halving, and there's sort of the release of a few but it's increasingly small number of extra Bitcoins get released over time. That it's effectively fixed in terms of the circulating supply. It's not quite fixed, but it's getting close to being sort of effectively fixed. Whereas in Convex, the amount of coins that's sort of issued actually starts really small. Yeah, so for Protonet, we'll probably have only about 500,000 to 1 million coins in circulation and allocated, which will be a pretty small number. that's certainly less than 1% of the protocol defined cap. So most of the coins are unallocated. Yeah, and this is a deliberate design decision. And this comes back to what I said earlier about sustainability and fairness. Yeah, if we just minted all the coins and gave them to our mates and said, okay, well, this is you now own a big chunk of the total maximum coin supply. They may do very well out of it, but then you then suddenly set up this zero-sum game again. Yeah, it all becomes about speculation. It all becomes about can you pump and dump. It all becomes about how do you somehow sucker the dumb money in, which I don't think is a healthy ecosystem. I don't think that's the kind of healthy model that you want to encourage. So instead, we do it the other way. We start the coin supply very small, and I see another question on YouTube. So there's the formula of the release curve. The price equal is $100 times x over 1 minus x. So what this means is there's always new coins available, but the price at which those new coins is available increases as more coins are purchased. Yeah. So let me give an example. If 50% of the coins are sold, yeah, then x is 50%, 1 minus x is 50%, so x over 1 minus x is just 1. Therefore, the price of the next coin would be $100. Yeah? And that is in the release curve formula for Convex. So at the point where half of the coins in the release curve have been sold, then the dollar price of the next coin on the release curve would be $100. Yeah?
Is that in code or is that a human managed thing?
Currently it's human managed, but it would be nice to put it in code. The problem is, in order to put that in a code, you need a price oracle. Yeah, and you need to say, okay, has this payment actually happened, and was it in the right currency, and et cetera, et cetera. There's a whole bunch of things that need to work in order for the release curve to operate that you can't do purely on chain. And I think this is the problem. Yeah, so we do want to find a decentralized way of administering this, but you can't do all of the release curve purely on chain without external interactions. So that's the challenge that we currently have. Now, in the long term, it may be possible to fully automate it on chain, but that's not possible, right now for various complicated technical and sort of integration reasons, and it would also be probably risky. So currently we just use we have a non-profit foundation which administers the release curve. But yes, theoretically it could be an on-chain thing, but we'd have to have a lot more sophisticated on-chain infrastructure. The whole decentralized economy would have to become much more sophisticated for that kind of thing to fully work on chain. So what happens is basically the price of the coins increases as more coins are sold. Yeah. So as you get to a higher percentage of the coin supply released, the price just keeps on going up. And in fact, it's this curve that goes up. I can show the chart briefly. Oops. This one. Yeah. So this is actually the curve that happens in Convex. So we have a release curve defined by this formula: P equals C times X over 1 minus X. And C is just a scaling constant, so that puts a sort of that translates the theoretical price into like a real world currency, which is currently the constant is $100 US. X is the proportion of the coins released. So what you see on this chart is when 50% of the coins are released, the coin price is about $100 and the market cap would be about 50 billion at that point. Yeah. So you can see we've designed this for the long run. We've designed this for being able to keep on scaling as we grow And as decentralized economic systems become bigger, we need the numbers to work. Yeah, which means we need to get to big numbers. Of course, we're starting off quite small, but that's fine because the coin price is therefore low, and and that creates therefore the right incentives for early purchasers to come in. Because as I say, part of a good tokenomics design is, do you create the right incentives for everyone who's adding value in the ecosystem? And I think this is really important. Yeah, you want the incentives to reward people who add value, and not reward people who don't add value, because otherwise you get negative behaviours. You get value that should be going to value creators going to people who are finding a way to extract value. So the model's very much built around that. We would expect early participants in the ecosystem to have a larger chance of gains. Yeah, and that follows naturally from the model. Yeah, if you buy at $10 and the price goes up to $100, you've done a 10x, and you're pretty happy with that. Yeah, so and the value, of course, of this is, well, if you come in as a purchaser of coins, you're you're contributing to helping them making the project a success, and you're giving funds back to the ecosystem. And this is a very important point. The release curve is a mechanism by which, as new buys of coins come in, that purchase price of those coins, well, it goes into the ecosystem treasury, so that then that money then gets spent further developing the ecosystem and investing in good projects and growing the ecosystem further. So assuming the treasury is well managed and well spent, it should have an even higher ROI as a result of that. So it's not like the money disappears. Yeah, when someone buys off the release curve, that money goes to use in the ecosystem, and that's a very important part of the tokenomics design. Yeah, you aren't stuck just with you raise 20 million and then that's all the money you ever raise, and you can't then do the development in the future. So this is designed to have a long run ecosystem treasury supporting the ecosystem, basically, and that gets funded out of the release curve. I don't know if that answers all the questions, but that's the sort of the basis of how it works. And then, of course, we've talked mostly about the finance side and the sort of the coin issuance, but I do think the most important thing in tokenomics is what utility you're creating. Yeah, so what are users getting, and in terms of about the capabilities of the protocol, what it enables them to do, what kind of products it supports, what kind of things can you build using the coins and using the coins as a utility token. So that is ultimately what this is about. It's about creating a tokenomics that will support people creating value. Yeah, and everything in this design is basically with that as the sort of the key goal. I see some more questions. So where the transaction fees from foundation peers going to? Yeah, so if the foundation runs a peer, then those coins are effectively treasury. Yeah, so that will get reused for the ecosystem. Yeah, good question, but yeah. So the foundation isn't. If the foundation will run some peers, but it's not running them to make a profit. It's running them for the stability of the network. Yeah. So any transaction fees that they get will just get don't sent back into the ecosystem and obviously we need to choose the right mechanisms and the right ways of doing that. But a very simple thing that peers can do is they can just donate their transaction fees back to the other peers. Yeah, so that just says, okay, well, I don't want my share of transaction fees. I'll just drop them back in the peer reward pool, and then the other peers can share them out. And if you do that every day, then you just end up recycling all of the peer rewards back to the other peers. So we might do that in the first instance, because the main purpose for the foundation running peers is to stabilize the network and just make sure that we've got well staked peers that are known to be under good and effective control is the purpose. You don't want to.
Hey, Mike, I got a question about value creation, like you're talking about. It seems to me that people who are going to build on Convex, their idea is to create value, but also to benefit, and like any commercial enterprise. However, it seems like we have certain values at Convex around tokenomics and what are good tokenomics and stuff. It almost seems like we should help, educate people who want to build on what good tokenomics looks like. How would we do something like that and kind of set the pattern and give guidance on, hey, we want this to be a sustainable market. So if you're thinking about tokenomics, here's some good education around what you would build as tokens.
I mean, that's a good question. I think it really, really depends on the product, what kind of tokenomics suit best. So the Convex model is sort of at the extreme end of the spectrum in that it has been designed as a public service utility network tokenomics. Yeah, it's not a commercial venture. It's not a VC-backed startup. It's a non-profit. It's a foundation model, and the aim is to make the technology and the ecosystem thrive and create good value in the world. And the Convex tokenomics is sort of built with that in mind. Having said that, I think there's probably some ideas from the Convex tokenomics which could apply to other kinds of operations. One of one of the things I think we definitely can do is provide some working examples of tokenomic models. So I think that a lot of people sort of invent their own tokenomics to some extent, and there probably are some sort of pre-built tokenomic models that could be that we could create
best practices.
Yeah. Well, for example, we could. The reason that it's very hard to do the convex release curve in a fully on-chain way is because it involves US dollars. Yeah, that's why we can't do the convex release curve on-chain, because it's got to be linked to the real-world dollar ecosystem. Yeah. Now, there's nothing to stop someone doing on-chain, and we could provide an example of this. Yeah, it's a fairly easy smart contract to write. We could provide a release curve, similar release curve that works denominated in convex coins. Yeah, so we could create a, and then you've got the link back to the dollars indirectly. Yeah, so we could say, okay, look, if you want a release curve based model, here's one. Here's a smart contract that you define the parameters. You say what shape of curve you want. You say, what scaling constants, what total max supply, etc., etc. You say, okay, I want one of those. You define your release curve formula or the shape of the curve, and then you just set it live. And what would happen is people then who wanted to buy the coin can just go to the smart contract and say, hey, I'd like to buy some of your token. And the smart contract, the actor, would issue mint, or either it would have a treasury and it would pay out from the treasury, or it would mint new coins. and give those to the purchasers, and the purchaser could pay in convex coins. Yeah, so that would basically give people a pre-built release curve. So they can define their own token, they can define their own rules, but then they could back the tokenomics by 100% by a on-chain actor with, you know, published rules and all of that. So everyone can see the workings, everyone can see the formula, everyone can validate that it's not going to do anything weird. And that might be a good model for some organisations and for some products. Yeah, and I do like these release curve models. I think they're a really good system. There's another system called a bonding curve, which is kind of a bit similar. The problem with bonding curves are a bit vulnerable to, because bonding curves people can withdraw. Yeah, whereas a release curve is kind of like it's like a one-way release. Yeah, you can buy from it, but you can't sell back to the release curve. Yeah, yeah. Whereas bonding curves sort of go two ways. A bonding curve is basically a release curve that goes both directions. Yeah, and what's the pros and cons of that? Well, the bonding curve lets you speculate. Yeah, bonding curves are brilliant for speculators. Yeah, you buy in when it's cheap, you wait for the price to go up, then you sell out, and your buys and sells are just against the bonding curve. You don't have to find any counterparty; it just happens automatically against the bonding curve. So, you know, it's kind of like a dex for you know, cashing in and buying in and cashing out. Yeah, and that's great for speculators. Yeah, but so most bonding curves realise this, and what they do is they make a difference. They like make a 10% or 20% difference between the buying and the selling price. Otherwise, it's just too unstable. Yeah.
Yeah.
But a release curve basically solves that problem by saying, look, this is just one way. Yeah. As the coins or the tokens or the coins on a release curve model get distributed just once when the price hits that point and when people buy off the curve, and then it stays at that price until someone comes along and buys the next tranche. So
that's the clearest explanation of a bonding curve I've ever heard.
Yeah.
Simply buying and
yeah, it is. I mean, bonding curves I think are good. They definitely have their places, but as I say, there's this problem that if you think you got in at the right time and you sell, and then the entire thing just collapses. Yeah. So bonding curves only really work, I think. And I think there is a very important place where bonding curves do work, and that is in markets where you have some other revenue stream which is getting distributed via the bonding curve. Yeah?
Got it.
So if you've got, let's say you have, I don't know, a shipping business. Yeah? Bit of a volatile industry, but that's going to make profits some year and it's going to make losses other years, etc., etc. But you got some. You want to tokenize the profits from your shipping business, and let's say you sort out all the governance and the tokenization and all of that. So it's all tokenized. You've got the profits ready to go. And everyone trusts that at the end of the year, an audited accountant is going to say, okay, the profits this year were 5 million, and I'm now, issuing $5 million of stable coins to the correct recipients. Now, if you design your bonding curve so that the shares in the bonding curve entitle you to a share of that revenue, then actually the bonding curve is quite effective. Because the only thing that people are not speculating on something on a pump and dump. They're not speculating based on market sentiment. They're speculating based on, or they're trading based on their prediction of what the future value of these profit streams are, and that's going to depend on a lot of things. Yeah, like the outlook for the shipping industry, the interest rates, what's happening in global conflicts, etc., etc. So then the bonding curve becomes a sort of a very good way of measuring people's predictions or aggregate predictions, market prediction about the valuation of those of that revenue stream. So I think bonding curves are really great for that, and that's because it's got a real value attached. It's got some, you know, it represents effectively a share of some real revenue stream. You don't have so much of the ambiguity about what, you know, a meme coin is worth, or the kind of things that can, where pump and dump happen, because everyone will go, nah, you're mad. There's no way it's worth that much. I'm selling now. Yeah. So you know, it would reward people who accurately gauge the value of that revenue stream.
So that would kind of be more like the stock market then, right?
Yeah, I think it's actually even better than the stock market in some ways. But yes.
But you're betting on what the company's going to do.
Yes, it's a very good model when you're trying to capture market sentiments about what something's worth.
Right.
Yeah.
You know, Mike, you mentioned this. If the release curve, and if people assume that a lot of people buy into that, you know, we've got the release curve on Convex, and a lot of projects decide, you know what, that seems like a really good way to model our tokenomics, and a bunch of projects do that. What's the implication for growing the internal economy of Convex if a lot of people are using that same release curve, you know, based off of the Convex release curve? Does that help or hurt our internal economy?
Oh, and I think it helps. I'm just wondering if there's any systematic effects of having lots of people running release curves at the same time. But I mean, I don't see why that would be a problem. You might start getting a bit of a sort of you might get some weird dynamic generated, and I'll have to think about this more. But let's say you've got 100 release curves, yeah, and they're all at different points. Yeah, one's at 10% issue, one's at 20% issue, one's at 90% issue, etc., etc. You've got all of these different. It becomes like a marketplace, yeah, and you know you get some people being really bullish about a particular release curve, and other people saying, "Nah, I don't think that one's worth it," or you know, etc., etc. So you might get some interesting dynamics where there's a certain amount of investment interest being spread across a bunch of different release curves, and the release curves sort of end up competing for a share of the investment. So yeah, I mean, it's kind of interesting. I mean, it might become like one of these sort of yield farming things, yeah, which is not necessarily a good thing, but you've got some kind of marketplace, you've got a whole bunch of different prices, a whole bunch of different metrics, and if they all have effectively the same API, yeah, then you know it's very easy to create a tool that just, you know, scans them all and, you know, gives the latest information on each. So yeah, that might be a fun little marketplace to set up if there's enough interest of people doing release curves. I don't see why not. I mean, it seems like a reasonable thing to be going on. Interest price bonds. Yeah. So yeah, seeing on the YouTube chat. Yeah. So pricing bonds is, I guess that might be related to the bonding curve. Is that related to the bonding curve? But yeah, you know, that's a good example where you're sort of, you know, pricing something that has potentially a stream of interest payments and this kind of thing. So yeah, and the Convex is absolutely fantastic for this. Yeah, if you've got some economic construct like a bond or a revenue stream or a or shares or something like that, and you want to define some interesting mechanism that distributes the value in an interesting way. This is exactly what the sort of a lot of the core convex infrastructure is perfectly set up to facilitate. Yeah, so it's what we mean by programmable economic systems. Yeah, you're programming in the rules of your economy that let you implement the mechanics that make sense. I just would say that it's really helpful to keep it simple. Yeah, the more complexity you put in these things, the more things can go wrong. And there's a reason why our release curve is so simple. It's got one formula. Yeah, and yeah, that's got a multiplication and a division and a minus in it. But I mean, it's not a complicated formula at all. And the more complicated you make your system, your tokenomic rules, the more things can go wrong. So I think implementing these is usually an exercise in saying what can you take out, because there's a bunch of things that you don't really need for the financial aspects or the economic aspects to work. So I'll give it a good example, like bonds often have a coupon payment, some kind of recurring payment that happens every 3 months or whatever I think it's usually 3 months, but whatever the terms of the bond are, and these are useful and people look at them and they spend a lot of time analysing. They just make the maths more complicated, and they don't really change the fact that you can get the effect of a bond with coupons just by having a whole bunch of zero coupon bonds. Yeah, if you really want, but you probably don't really care, so you just use a zero coupon bond. It's much simpler, and you can price it probably more easily, and there's less administration and there's less things that can go wrong. So this kind of thing, you want to try and design your primitives, your composable units for your economic system as simply as possible, and then it's easier then to plug them together. It's easier to price them. It's easier to build smart contracts and systems that interact with them, and this kind of thing. The complexity is the curse of I think programming anything in the decentralized world. The more complex you make it, the more things can go wrong, and your risk becomes much higher as a result. Just checking.
Well, it's crazy how fast an hour goes, isn't it?
Yeah, I know it is. Just checking if I missed any questions and going through. So one of the ones, the value created by the use case on Convex could have a higher value than Convex. Yeah, I mean that's totally fine, no problem. So yeah, if Apple wants to list on Convex and put all its equity on Convex, then the market cap of that token would probably be larger than the market cap of the Convex coin for at least a reasonable while. So there's nothing wrong with that. Yeah, I mean Convex is a platform for enabling economic systems. It doesn't mean it's the entirety of the economic system. Yeah, it's simply making.
Yeah, if somebody decided to do a CBDC on there, with a nation's coin.
Exactly. So nation coins, some of these initiatives could easily have higher circulating value than the Convex coin itself. Sure. And to be honest, I'll consider it a success when we get to that point. Yeah. The aim of this ecosystem is to create value in the broader world, rather than to inflate a coin price, and that's why we're doing it. We're doing it so that we can have productive, fair, and efficient economies that can run on at a level of efficiency that isn't currently possible. So yeah, that will be a win as far as I'm concerned.
Yeah, you can take that reputation to your grave. You can't take the money to your grave.
Exactly. All right, I think we're coming to the end of the hour. Thanks for all the great questions. As always, there's some really interesting comments, some insights, some good questions, and as always, lots of things to think about. So thanks all for joining, and look forward to seeing you all again soon. Take care. Bye for now.